Alright, fellow AMC stockholders, XMAX Trading here. We'll go over some pretty exciting DD on it, my reaction to it. So go ahead and subscribe to the channel if you haven't already. Hit the like button. Helps out the channel and the YouTube algorithm. So let's get started. So this is a pretty important DD I found. The volatility of a squeeze. The great short squeeze has begun and it will crash the market. Obviously it's not financial advice from me or the author, but it's definitely something to think about. Anatomy of a squeeze. What is a short squeeze? Occurs when asymmetric tails meet forced covering. GameStop brought the term short squeeze into headlines when the stock exploded from $350 to nearly $350 back in January. But the GameStop squeeze did not occur on January 27th. That is the date it ended. The actual squeeze looked like this. So let's say it went up to 50. Actual squeeze. Boom, 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 goes down, and then it goes up, what, 44 right there. GameStop is a brick-and-mortar retailer. On the losing end of secular trends, GameStop dropped over 94% over the 6 years. At some point, short and GME became free money. The allure of free money is bound to draw interest. That's not immediately a problem. In fact, it's a benefit. As the trade draws more attention, more players will join in shorting the stock, which drives the price down further, which benefits benefiting those already in the trade. Everybody who is short wins together. However, with all the systems that rely on equilibrium, there is a tipping point. At some point, free money machine goes too far. The risk-reward proposition flips, both due to the limited remaining value to harvest and the crowded nature of the trade. It wasn't apes or moon boys that launched GME strategy. Rather, it was value-minded contrarians who recognized the consensus that the free money machine had overshot and was at a risk of a messy unwind. The GameStop squeeze began August 31st, 2020, after trading below $4. Stocks saw several bursts of significant buying interest throughout the fall and winter, driving the share prices actually up. I didn't know this. This is pretty amazing, you know, guys. This is pretty surprising to me to find this out. Search out in September, who may be too concerned when the stock ran from $4 to $8. A smart investor who may have made a lot of money short in GME has not changed their opinion on the company that it's a sinking ship. But what about when the stock breaks $10 in September, 15 in October, 20 in December? Those months where the actual short squeeze occurred. If new buyers force a short to close their position, it immediately adds upward pressure on the stock by closing the shorts. But if shorts can overpower the longs, you can see them double down their shorts, doubling down at an attractive price. It's a war of attrition. However, the asymmetric at this midpoint of the battle is anything but tail end of the distributions. Shorting a stock at $10 means your maximum profit of the stock is $10, the stock goes to zero. But if you short a stock and it goes up, there's no cap on how much you can lose. If the trade goes to $20, you lose 10. If it runs to 30, you lose 20, and so forth. This is problematic because you may not have $20 to lose. Since the shorter stock is inherently levered, since it's borrowed, forced selling is the eventual outcome. This asymmetry is why you can't squeeze longs. Forced covering makes the stock goes up. Forced covering in a crowded short sends the stock to the moon. A short squeeze is the meaning of asymmetric tails and forced covering. GME just demonstrated several points. Shorting GME was smart and profitable for years, which attracted the attention of in a long-term self-reinforcing cycle. Crowded trade reached a tipping point of the risk-reward. Squeeze began August 31st and ended January 27th. Contrarians recognized the squeeze ultimately made a fortune while short sellers wiped out. With this background, what if I told you that the next short squeeze already begun and its impact on the market would dwarf that of GameStop? The next short squeeze will not be a stock, but rather a financial product that is much more important: volatility. Volatility complex sounds like a measurement, but it's no longer the case. Volatility is a traded product, complete with its own second and third order derivatives. More importantly, it influences the price of every financial asset. In fact, I argue it is the most consequential product in the market. Wow, I didn't know that. Volatility is the most important product in the market. A call option is the right to purchase shares at a given price. In the future, at its core, the option is a forward purchase agreement. This is easy to value, multiply price times quantity, adjusted for the time value of the money. But since an option is a right, not an obligation, it becomes harder to value. You must make an assumption about the movement of the stock that says the probability of an option the money. So in other words, you make an assumption for the stock's volatility. It's also said if you're trading options, it's not really the stock you're trading, but you're trading volatility. Since option pricing can be broken down mathematically, you can look at the current price of options and infer volatility of the market expects. This is implied volatility, because implied volatility is from the current market pricing of options. This implied volatility can be quantified into indexes such as the VIX, which measures the implied volatility. Implied volatility does not represent the risk of market, it represents the market price of risk. The quantification of volatility went from being a source of information in the market price to being a product in of itself. The rationale for such a product makes sense. If your business is trading options is trading volatility, then having a tradable product that tracks implied volatility can be valuable for hedging your exposures. But in this case, with most derivatives, a risk mitigation tool is just an easy tool for leverage speculation. If one wants to direct long volatility exposure, you can buy VIX futures contracts and never have to worry about buying options or shares. It doesn't stop there. There are structured VIX futures contracts and derivatives on those products. One can buy traded products known as ETPs or ETNs that provide long or short exposure through buying VIX contracts, some which employ leverage. Furthermore, you can even buy options on these ETPs or even contracts on the volatility of the volatility, the VVIX. Movements of these products will have direct impacts up and down the derivative chain, sometimes magnifying in surprising ways. These products also interact indirectly through the reliability consistent actions of market participants, at which exposure of each level. For example, an options dealer will buy or sell equities in order to hedge their position. A risk parity fund will also scale its equity exposure based on measures of volatility. Even a retail trader who sold strangles and is spiking liquidity may have their broker liquidate other holdings to cover their exposure. Together, they make the volatility complex. Direct relationships, shares, options, volatility contracts, first order derivative. Oh, geez. All these derivatives, right? All these mousetraps. Second order derivative, third order derivative, fourth order derivative. So, shares go to options, volatility contracts, volatility structured products, long and short ETPs, and then volatility product derivatives, options and ETPs. Indirect relationship with the dealer, risk parity funds, portfolio management, market correlation, investor psychology, unforeseen shocks like GME. Diagram simplification and reality structure is repeated over and over again in single name stocks, large ETFs, indexes, all interacting with each other, and underlying shares in complex ways under the surface, and yet all bound by certain unifying forces. Each incremental derivative level creates incremental potential exposure and complexity, which magnifies the potential short exposure if things go wrong. Ever-growing chain of volatility products is increasing the size relative to underlying assets. The challenging of isolating indirect relationships means no one has an accurate model. No one has an accurate model of how these pieces fit together, the outcomes. Volatility easily squeezed. Volatility is a traded product. But similar to GameStop asymmetric tails, short volatility is a very long tail of downside. Don't want to short volatility. A put option is insurance. Buying a put gives you the right to sell a stock at a certain price. The potential exposure of traders take by selling this insurance is multiples higher than the actual money they receive in the trade. Volatility is complex. If you're short the VIX, volatility spikes, you can see meaningful losses. This may be done simply by selling the product or buying volatility as an asset, but the net result is that a former seller of volatility is forced to be a buyer, which adds up to upward pressure. This is not theoretical. For example, a short squeeze prior to GameStop occurred in February, known as the Volmageddon. And the VIX spiked from 1737 a day, below the graph the VIX. There is no external catalyst for a market event that seemed to justify the massive increase in volatility. Post-mortem of Volmageddon on VW. A sudden rise in market volatility on February 28 led to one-day losses of more than 90% in short-traded volatility exchange products. Both the VIX, both ETPs, were designed to provide investors with return on mirrors of inverse performance of S&P 500 VIX short-term futures, shorting volatility. When volatility spiked, there's a sharp fall in the volume of short volatility ETPs, increased the notion that need to buy a large number of VIX futures contracts to remain market neutral. The purchase of VIX futures has a significant impact on price. This is further rebalancing and shrinkage of AUM. The large market share of VIX contracts held by leveraged ETPs exacerbated the volatility shock, sending ETP's rebalancing mechanism into overdrive. This negative feedback loop kept pushing futures prices upward, leading to huge downward pressure on ETP's AUM, eventually to investors' losses around 90%. In simpler terms, when volatility is squeezed, specifically a structured volatility product was squeezed, the mathematical process employed by the structured product creates a feedback loop. Wow, guys. This could impact GME and AMC and all of them. The VIX starts really spiking. As with GameStop, the roots of Volmageddon far preceded February 5, 2018. Up to early 2018, VIX had been a consistent decline, Consistent decline since 2016. For years, shorting the VIX was a great trade. In fact, it became free money. Where have we heard this before? Each volatility spike temporarily didn't performance became as VIX continued to drift lower and lower. As all free money trades became crowded, each piece became bigger and bigger, and the dramatic death of the VIX. Boom, shoots up 2018. Inverse ETF implodes, the VIX-mageddon turmoil. Further, while the focus on optimal positioning occurred on February 5th, the short squeeze began well before. The VIX reached the recent low of 9 on January 4th, less than 9 prior to Volmageddon. Significant pressure on volatility sellers. The explosion on February 5th was made a short seller. The shrewd trader would notice the VIX rising early January and closed their short position or bought volatility in advance. A shrewd trader may have had much further warning, noting the volatility of the VIX and the volatility of volatility, VVIX, has significantly decoupled from the historical correlation, implying the market could be under pricing volatility. VIX continued to decline, VVIX continued to increase. Ultimately, the two converged on Volmageddon. Holy moly! Look at that Volmageddon, guys. We got to track the VIX and the VVIX. You know, that's what we got to do as traders. Volmageddon follows the same architecture as GameStop. Shorting volatility was profitable. Crowded trade reached a tipping point. Short squeeze occurred January 4th to February 2nd, ended in the capitulation on February 5th. Contrarians who recognized the squeeze in real time made great returns, while short sellers were wiped out. Short squeeze is medium asymmetric tails and forced covering. Important, there's no obvious catalyst for the market movement. Rather, it's due solely to forced covering of derivative products. Volatility, measured by the VIX, declined since 2020. It's getting low, guys. With extraordinary realized volatility, due to the panic of the COVID market, price of volatility was incredibly elevated. Meanwhile, volatility since has compressed. Insurance has never paid out. Below is the realized S&P volatility. Volmageddon. COVID-19 right there. Compression of realized volatility is compressing markets pricing of volatility. This seems intuitive, but it's actually a gambler's fallacy. The reason here does not necessarily dictate future. And long historical look shows a period of high increased volatility and often occur abruptly after a long period of declining realized volatility. Here's a picture I want to show you guys to break up this. Oh, not that one. Yeah, conspiracy theories regarding users of intellect. This is a little nugget for you guys. Some funds pissed off Citadel yesterday as they covered some AMC. Some funds are pissed at Citadel. The pressure on Citadel has gotten some hedges rightly concerned whether they can continue to hide their billions of shorts positions, billions of shorts in puts. Whether they can continue to hide billions of short shares if they go under investigation. More to come. So some hedge funds are pissed. All right, let's get back to from that Easter egg. Looking at correlation between the VIX blue and the VIX orange, which is an easy forewarning of Volmageddon, we notice more ominous signs. After remaining relatively coupled over a year, March 2020 and April 21, the VVIX reached a post-COVID low of April 9th, has risen significantly. Meanwhile, VIX has continued to decline. This VVIX divergence of the past several months, quick convergence we're seeing today corresponds to the prior action of the most two recent volatility squeezes. The September 18, 2018 sell-off, the March 2020 COVID crash. While this divergence is a longer-term risk, it doesn't mean a reversion is imminent. But more recent action of VX proves an imminent warning. After driving into new lows, the VIX has risen on 50%. This important factor with squeeze dynamics is a change off the lows. With each movement higher, there's more pressure on volatility sellers. Like GameStop from 4 to 20, losses can be withstood for a period of time, but not indefinitely. At some point, someone goes upside down and is forced to sell. At some point, something really big goes down. A short squeeze is the meaning of asymmetric tails and forced covering. Yes, the VIX has increased for extended periods of time since the COVID crash has increased, but there's still a key difference. First of all, the lower the VIX, the more crowded the trade becomes, and more likely a squeeze. Looking back at the VVIX chart, the VX looks appropriately priced to the VVIX prior to April 2021, implying the market has no meaningful underpriced volatility. Third, shorting volatility become more and more crowded trade. And finally, economic outlook by all measures have seen improving. Today, the opposite is true. Growth has peaked, fiscal monetary has ended, dollar liquidity is fading, inflation is a real concern, corporate margins are under pressure, burgeoning energy crisis, potential U.S. default. Not out of the cards yet. The rise in volatility has come with a meaningful increase in realized volatility. The rise in volatility, meaningful increase in realized volatility, with equity selling off significantly. The squeeze will play over time before its final capitulation. The capitulation may be triggered by a period of high realized volatility, which may put specific volatility sellers out of the money. Alternatively, a slower shift in the balance of volatility supply could cause more gradual repricing of volatility. Given the intertwined volatility derivative universe, we can't predict exactly when the volatility complex would arise, but a breakdown at any level of the derivative chain would lead to chaos elsewhere. These are enormous potential exposures. It's certainly possible that short sellers remain in control of the market for the weeks or months ahead, but until VX takes out the lowest supply, the battle is on. Okay, maybe you consider a trader. Do you care? Yes, you need to care. The Devils Correlation. Volatility is negatively correlated with price. If volatility is squeezed, the market will go down fast. If you believe it's possible the VIX to spike, then you believe the market will crash. Devils Correlation means owning equities is effectively shorting volatility. Shorting volatility is merely a highly leveraged bet the market will not go down. This is no implication for anyone in the market, regardless if there's a direct participant in the market or not. To demonstrate, VX inverted left axis, S&P 500 left hand inverted left axis. This is not cherry picking for a particularly correlated week. You can see repeated exercise any day, and you find the correlation. S&P, the VIX is in orange. The VIX is inversed on the orange. Really matched, guys. This is pretty amazing. I'm pretty shocked by this. This is my reaction. I mean, this is... So we need to compare this trade, you know. The correlation is demonstrated by much longer periods. Below the scatter plot showing the daily percentage of S&P 500. On the absolute change of VX, there are square linear regression. So volatility goes up, price goes down. Volatility up, price down. And one day, change in the VIX. The correlation gets increasingly extreme movement, splitting the data set, 1 standard deviation, 1 to 3 standard deviations, greater than 3 standard deviations. March of 2020, March 2020. We may not be able to prove why this correlation exists, but the only thing that matters is its clear existence. Ultimately, to derive a mathematical correlation would require a complete accurate model of volatility complex. We can't do it at any point possible in terms of, yeah. Wow, Volmageddon, yeah, the volatility spikes, prices go down. Again, spike, go down. COVID spike, whoop, volatility. If volatility spikes, the market as a whole will experience significant drawdown. I'm not telling this to get clicks or subscribes. I'm telling this because what I believe is true. The reasons for these highs are largely due to the self-reinforcing cycle of shorting the VIX. How a sell-off could go, market could go through 3 unwinds of each lower to lower. In other words, the market has simply higher prices than previous, yet less stable. I worry a squeeze could be very swift and violent for a number of reasons. The volatility market size, the notional value of the options has eclipsed the actual volume of underlying shares, highly leveraged. Asymmetric options positioning, yeah, there's a lot more people selling. Crowded short volatility, market leverage, neutered Fed, deteriorating macro. Dealers are hedged. To address the risk models exist prior to every extreme market. Powell will print, again, no trigger. Conclusions of position. Volatility is the most important force in the market. By quantifying and trading and speculating on volatility, we add significant risk to the market. Now market has two sides of the same trade, short volatility or long volatility. Short volatility is now becoming crowded. Not only or not, the market is now a roulette wheel. Short volatility is like betting on red and black. Most likely to win most spins, but payout gets smaller and smaller. For less experienced traders, experienced those who started out since March 2020, you have already won almost. Your time, the greatest bull run in history to perfection. In the face of experts, including this bear, who told you it was a bad idea. But while your account shows a total balance in dollars, you didn't have dollars. You own shares of companies which are forced to be shown at the present exchange rate due to dollars. The key to investing is to buy low and sell high. I won't come out of gain from volatility spike, but it should be straightforward. Either be on the sides or the right sides of the squeeze. The more people begin to position themselves to the possibility, more likely it is to occur that the market volatility shifts from sellers to buyers. It is self-fulfilling, contrary. If volatility sellers, win the war of attrition, it may take longer for capitulation. Breaking new lows in the VIX would indicate the squeeze is off for the time being. Unfortunately, there are serious ramifications that go beyond the market. A significant volatility unwind draws down market down real and have real effects on people being financial stability in the economy. Only you need to prepare, ignore borrowing costs. Recent data shows it was. Wow, guys. Pretty amazing. VIX and VVIX. Look it up, guys. Hopefully it makes the squeeze happen. Alright, till later.